Good day. It's Rob Folia with Folia Properties at Keller Williams Realty here in Nashville. And it is the first of the month. It is June 1st. And so you know what that means. It is time for another edition of the Real Estate Show, where we dive into what's happening in the real estate market and we can get an idea of just what's how the market actually looks. We hear a lot of conjecture in the news. We hear a lot of narratives, a lot of different things that are out there. I'll say a lot of industry professionals will throw a lot of narratives out there as well to paint a certain picture, and some of that might be just based on location and geography as well. And yet what we're going to do is we're going to dive in and look at the actual facts for the Middle Tennessee, Nashville area and see how things are going, because the reality is this market is different than it was earlier this year, or different than it was last year, different than it was in 2021. And let's just dive right in and take a look. First and foremost, I just want to look at interest rates. This is straight from the Freddie Mac website. These are numbers that are through May 25th. They update every week, once a week. And so they'll probably actually update later today. And yet you can see for the week ending last week, 6.57% was the 30-year fixed average. So roughly 6.5%. They might have even ticked up a little bit more than that. Long story short, I'd say somewhere in that 6.5 to 7% is pretty much par for a 30-year fixed conventional mortgage. This is a pretty big change from even a year ago. Just look at what it was a year ago. It was 5% basically, low fives. If you go back even just a little bit more than that, if you go back to, let's just say, where's January 1st of 22 or January 6th of 22, 3.22%. And so it's more than double that. That does impact affordability. So just one thing to keep in mind. So if you're a home buyer, just make sure you crunch the numbers. Reach out to me. I'm happy to do that with you. I'm also happy to get you connected with one of my trusted mortgage advisors, because I know they'll do that as well. They'll make sure that you have just full knowledge of what the numbers might look like for a house payment, and make sure that you feel comfortable with that. Because the last thing you want to do is overextend yourself. I've heard too many agents, too many lenders over the last year say, marry the house and date the rate. Guys, that is terrible advice, because the reality is we don't know. When they say date the rate, they're thinking about refinancing later. We just don't know when or if rates will ever drop. I mean, we may never see in the threes or fours again. A lot of experts, quote unquote experts, were saying by now we'd be seeing rates that were, what it was this time last year in the fives. And if anything, it's been climbing recently. So just something to keep in mind as we're, just in this current market. So if you're a home buyer, again, don't marry the house and date the rate. You're marrying that rate as well for the next 30 years. Just keep that in mind. Make sure you can afford your payment. Make sure you're living at your means, so you're not overextending yourself. But let's look at Nashville. Let's look at Davidson County, because the reality is this is going to be what helps us get hyper local for Middle Tennessee. If you're in our area as well, our coverage area of Middle Tennessee, and you want to know what's happening in your specific neighborhood, maybe you're in Murfreesboro, maybe you're in Franklin or Hendersonville or Dixon or wherever it might be, reach out. I'm happy to run the numbers for you in particular, and we can look at everything. But first and foremost, let's start with months of supply. So if this is the first time seeing one of our videos, months of supply is just a real estate stat that helps us see if real estate is in a buyer's market, a seller's market, or a balanced market. Economists think between 5 and 7 months is balanced, less than 5 is a seller's, more than 7 is a buyer's. And the further you stray from that middle range, the more extreme of a market it is. Like, just think back to the beginning of last year in Nashville, 1.7 months of supply, the most extreme seller's market we've ever seen, where homes were going for, 15 to 20% or more above asking. We're not in that type of market right now, and yet 2.9 months of supply, that is a negative trend for months of supply. That means we might be heading toward more of a seller's market. Maybe we're heading back here. We'll see what happens. One thing that I find interesting looking at this trend, and I've been analyzing these stats for years, and so let's even go back pre-COVID here. So say 2018, 2019, you can see typically months of supply runs at kind of a bell curve, where it just slowly creeps up throughout the year. And then somewhere toward the end of the year in Q4, it just kind of drops off because less people are looking to move around the holidays. And then it starts slowly creeping back up. And then this time it's really peaking, and then boom, it usually drops off. You even saw the same thing in 2020, even though the market was kind of wonky in 2020 with the pandemic. 21 was when, we really saw that shortage of inventory hit, and you can see it was a bell curve, just kind of a slanted bell curve, where it peaked in January and then just kept going down and down. In 22, it was kind of a bell curve, but it jumped at the end of the year. Big part of this was interest rates. I mean, we just talked about rates rising last year. Well, rates rose at the end of last year as well, or they rose last year. What I'm getting at is that made months of supply rise. The interesting thing I'm seeing is this was normal. The first few months of the year, it rising slightly here. I mean, it's basically flat. If you think about January through April, 3.2 to 3.4, that's basically flat. There's no, rise of 2.7 to 3.1. I mean, even that's only half a month, but still, it was basically flat for these 4 months. Now we've seen it drop half a month of supply from April to May. A negative trend right there that we typically don't see this time of year. And so that makes me think we could be seeing something like this again, just something to keep in mind. Hopefully that doesn't happen, because honestly, that was this market right here, beginning of 22, while great for some sellers. I mean, some sellers cashed out in a fantastic way. It was a market where buyers just, a typical home buyer getting a loan that had maybe 5-10% down, they just really struggled to compete. And so I hope we don't get back into that market. It was a market that just, really had just a few winners and a lot of people that were, struggling in that market. So hopefully we don't see that again, but just something to keep in mind. My advice would be, if you're looking to do something, now is the time, because, we're not in this market yet. Because most people, let's face it, if you're selling a home, you're also buying a home. So if you're selling in this market, you're having to compete with the million other buyers in that market too. And so point being, now's a great time to look at things, because it's a strong seller's market. And yet we're not in the market like some other parts of the country where there's 20 offers in 20 minutes for 20% above asking. We're not seeing that quite yet here. So it might be a good time to, to take some action, is what I'm getting at. But let's also look at sales price. So we're looking at just median sales price here for Davidson County. And it's always going to have ups and downs. I mean, it's just the reality of it. It's a median reporting tool. There's always just going to be some peaks and valleys when we're looking month by month. And yet what I really like to look at here is the year over year trend. So we're down 6.7% year over year. And there's a reason for that. Look at May of last year, $473,000. This was that peak that we saw before, as interest rates were really, as they were starting to rise. In fact, let's just go back and take a look at the 1-year interest rates, just to put it in perspective. Rates were, again, they were about 5%. They started to jump in June, really into the high fives, went back down, and then toward the September, October, November really got into the 6s and 7s. That's when we saw prices go down, because it impacted affordability, et cetera. So this was kind of the peak, because people who were closing in May last year, they had contracted in April, rates were still in the 4s. They were really wanting to get in with that low rate. They were even willing to overpay some. So long story short, to me, down 6.7% is not a bad thing. Because this right here, if you look at this increase from just January of 22 to May of 22, that's an increase of close to 20%. It might actually be 20. I'm just trying to do the mental math. $73,000 over 5 months. That's these price points, that's a lot. And for a 5-month increase. And so the reality is, if we're down 6.7% as a median, that's not a bad thing. It's really not, especially when we're seeing a positive trend here this year from January through May. You can see, I mean, it's gone up from 420 to 441. I mean, that's an increase of about 4 to 5% here just this year. That's a good thing. That, to me, that's telling us we have a healthy market. It's a seller's market, just like we saw with the months of supply. And yet at the same time, it's not peaking like this. Now, fair warning, if we see this again, if we see 2 months, 1.7 months, 1.9 months of supply, we might be back. Let me get my stats correct here. We might be back to this, because we might be back to a peak like this, just in an insane active growth. Again, that's not what we're looking for in the market. Maybe a handful of sellers who are looking to cash out and go, ride out the rest of their life on a beach, like that might be a great market for them. And yet for 99% of the people in our economy, that's not the market we're looking for. A market like we're in right here is a market that we're looking for. What's impacting this? Again, it's supply and demand. We've talked about months of supply, but it's new listings too. I mean, let's just look at new listings again. I'm just looking at Davidson County, but I mean, these numbers are pretty straightforward across the board for neighboring counties too. We're down 33% new listings from May of 22 to May of 23 to May of 22. May of 22, we were at about 1,900 May of 23, a little bit shy of 1,300. That's a pretty substantial drop. That means there's less homes to choose from, less homes, and yet buyers that are out there. That's what helps make supply and demand get like this. We want it to be like this, or maybe more demand and a little less supply to help drive the market upward in a good way, especially if rates were low. We'd want that. And yet if supply is going to stay low and demand's up here, if this keeps dropping, it just keeps making things get out of whack. So hope that makes sense just with the visual. Hope you can see it there on the screen. And you can see the same thing in homes for sale. Homes for sale general, just as a whole in Davidson County, down over 11 or over 10%, almost 11% year over year. That's a big change. It really, really is. And it's just again, bringing all this up, I just want to make sure that I'm giving you all the actual stats, the real numbers to take a look at, because when you're deciding to make a move, or to whether it's to uproot your family or to buy that new home down the street, you've got to know what you're getting yourself into. To me, it's a great time right now to be doing it. Just make sure, again, interest rates, make sure it's affordable for you to do it. Make sure if you're getting a loan, it makes sense. Because to some it will, to some it won't, and it's okay if it doesn't make sense for you for right now. It might mean it's not in the cards for right now, and that's okay. And yet if it does make sense, now might be a good time to do it, because selling, you're going to get a good price, and buying, it's not that market that we saw 18 months ago at the beginning of last year, and yet signs are showing it might get that way. I mean, I'll be curious to see what it looks like in June, for the stats for June when we get into July. If it's continuing to go down, if we're seeing less than 2.9 months, then that's kind of a warning sign that we might be getting back to this, even with high rates, which makes it kind of almost like a desert out there in terms of less homes and less buyers as well with the high rates. Because if you think about it, again, months of supply typically going back, it's always trending upward. It's usually not a huge peak month, from May to June, but it's trending upward. You can see right here, 18, it was going up. 19, it was going up just slightly. In 20, again, that was a pandemic, but still, we can even go back just a little bit further as well. In 17, going back from May, 3.1, 3.2. So typically it does just increase a little bit from May to June. So we'll see what it does here. Maybe it does go up a little bit, and that's going to be a good thing. And yet if it doesn't, that's kind of a sign that our market might be heading back to this. And that's, I'll let you judge if you think that's a good thing or a bad thing. In fact, I'd be curious. Leave a comment. Let me know what you're thinking. Is that a good thing? Is that a bad thing? If you're seeing this in your email and you have a question about what all this means, just reach out, hit that reply button. Happy to help however I can. If you could follow, subscribe on socials. We'd love to keep in touch with you. This is a big way that we communicate, because we just want to make sure that we're keeping you informed on what's actually happening in the market. So guys, until next time, thank you all so much for tuning into the Real Real Estate Show. We will be back with a new episode at the beginning of every single month, as well as some special editions throughout the month too. So stay tuned, and we'll see you soon. Thanks, y'all.